Hi, my name is Troy Emory, and we're going to talk today about the new tax changes in 2018. I've been in business now for 11 years, and we're going to get into the new tax changes that everyone's talking about these days.
So here you go. You're going to have higher standard deductions, right? Married filing jointly, your standard deduction is going to be $24,000. Married filing separately, single is going to be $12,000. Hit a household, you're going to be $18,000. Okay. Now, they did this because some of the itemized deductions are going away, right? And according to the Republicans and President Trump, they're saying, look, instead of putting all those itemized deductions on your Schedule A, we'll just increase your standard deduction. All right. Some people it's going to work really nicely for. Some people it will not. Okay. And while we're on this point, let me just tell you some of the people who that's going to really affect. If you live in a jurisdiction where you pay high property taxes, like Prince George's County, believe it or not, Prince George's County pays an awesome amount of property taxes. And there's a lot of things that go into the property tax rates. Okay. Future growth. Future growth is probably the biggest driver of property taxes. So the potential for growth in Prince George's County is probably much higher than, say, a Montgomery County. Montgomery County is pretty congested. It's pretty, they got the sidewalks already. They got the sewers already. But in Prince George's County, you got a lot of undeveloped space. So the potential of growth is higher. So it's going to affect counties that have high property taxes. It's going to affect people who live in states with high income taxes. So Maryland is going to be a double whammy because Maryland has some of the highest income tax rates, right? And then you're going to double it by having Prince George's County and its high property taxes. So people in Prince George's County will feel the squeeze on this one. I guarantee you that one. But as last year, you got a 4150. You got 4150 in personal exemptions. Again, personal exemptions go away. All right. Let's go to the next slide. All right, child tax credit. We kind of alluded to this before. There was a $1,000 child tax credit in 2017, 2000, and 2018 and beyond. This is important. $1,400 is refundable. Y'all know what refundable means? Okay, here's what refundable means. If my taxes are, say, $2,000, okay, then I can take a $1,400 credit against those taxes, okay, dollar for dollar, right? But if my tax bill is, say, $600, I can only take $600 of this. You understand what refundable is now? One is dollar for dollar. One is just to reduce your tax liability to zero. All right. So I really thought that when they first came out with this law, I thought that the dependents were going to be limited to 2. So it would be a maximum of $4,000 tax credit. But I did find out later that it doesn't make a difference how many children you have. You can still take $2,000 per child as long as you got the taxes to absorb it. Okay. This is one of the benefits for people who put a lot of deductions on their returns, and I mean a lot of exemptions on the returns. Now I find families that might have 6, 7, 8 exemptions on the return. I don't ask them who these people are, but if you have a lot of children, hey, that ain't none of my business. I got 4 myself, but this is going to help people they got those large number of dependents, and of course, there's going to be an unlimited number of the $2,000 credits, considering they can absorb the tax, considering that these are real qualified dependents.
If you guys want to reach me, you can reach me at 301-474-1040, or you can email me at troy_emory@tdecpa.com, or go out to our website, www.tdecpa.com.